Hey everyone, and welcome to today's Explainer. So, if you've been keeping an eye on the markets lately, and let's be honest, who hasn't been kind of glued to those charts, you've probably heard a massive amount of buzz around high dividend yield ETFs. But what's actually going on beneath the hood? Today, we're going to literally dissect these investments. We're looking at the true anatomy of a smart investment, using the data straight from our source material to figure out if these funds actually live up to all the hype. Let's get right into it. Let me ask you a quick question. Is the market feeling, well, a little bit volatile to you right now? Because, yeah, it's completely natural to crave a steady, predictable stream of income when the charts are just bouncing all over the place. I mean, when things get turbulent, looking for a safe harbor, a place with reliable cash flow, isn't just common sense, it's honestly just smart investing. So here's our game plan for today. First, the high dividend appeal. Second, core screening mechanisms. Third, advantages and hidden risks. And finally, number 4, smart portfolio allocation. All right, let's kick things off with Section 1, the high dividends appeal. You see, the whole logic behind high dividend ETFs really boils down to one incredibly satisfying concept: pocketing the gains. Rather than just sitting there watching these paper numbers go up and down on your digital screen, these funds act like a giant filter. They actively hunt down financially sound companies that are actually willing to hand profits directly back to you, the shareholder. It's about creating a regular stream of passive income. And honestly, there is a massive psychological comfort in securing those tangible returns. It's cash in your actual pocket, not just on a ledger. Moving right along to Section 2, core screening mechanisms. Now, as we look under the hood here, we absolutely have to talk about the dividend trap. This is crucial. There's this huge misconception out there that the absolute highest yield equals the absolute best investment. But actually, scratch that. It's more like a seesaw. Since a dividend yield is just a percentage of the stock price, if a company's stock completely crashes, its yield is going to mathematically skyrocket. You definitely don't want to get lured into buying a crashing stock just because that percentage sign looks temporarily huge, right? So how do we avoid that trap? Well, really high-quality ETFs use 3 super rigorous screening layers. Step 1 is profitability. The company has to show continuous profit. We want to be absolutely sure they aren't just out there borrowing money to pay you your dividend. Step 2 is stability. The fund managers are looking for a rock-solid 3 to 5 year track record of reliable payouts. And finally, Step 3, liquidity. They specifically filter for companies with a massive overall value, a large market cap. Why? Because it lowers the risk of what we call liquidity shocks. Basically, it guarantees you can easily buy or sell your shares, even if the rest of the market is in total panic mode. Which brings us to Section 3, advantages and hidden risks. Okay, let's weigh this out, because it's truly a double-edged sword. On the pro side, we've got psychological resilience and compound interest. Think about it. When the market is just dragging sideways, getting those regular cash dividends gives you a real, tangible sense of return. Plus, if you reinvest them, you trigger that incredible power of compound interest. But there's always a but, right? On the con side, we're looking at limited growth and tax costs. That warm, fuzzy comfort of regular dividends, it does come with some pretty strict inherent mathematical limits. Let's candidly break down those hidden risks for a second. First off, high-dividend companies are usually older, mature players in industries like finance, telecom, or energy. They are wonderfully stable, sure, but they completely lack the explosive rocket ship growth you might see in the tech sector. And second, well, the tax man always gets his cut. Cash dividends are usually subject to income tax. Our source material points out a great specific example. In Taiwan, these dividends can get hit by both regular income tax and second-generation national health insurance premiums. It is absolutely crucial to remember that these little fees will organically eat away at your actual take-home returns over time. Okay, last but not least, Section 4, smart portfolio allocation. So who is this whole setup actually for? Well, high-dividend ETFs are basically perfect for retirees who need that reliable cash flow right now, or for investors who are specifically looking for steady, incremental growth rather than those wild, stress-inducing market spikes. If that sounds like you, your best actionable strategy is to actually look up the specific component stocks inside the ETF and pay close attention to the payout frequency. Whether it's paying out monthly or quarterly, you've got to make sure that schedule aligns with your own real-world cash flow needs. And this leads us straight into what I like to call the golden rule of investing. Do not put all your eggs in the dividend basket. The absolute most resilient strategy you can use is to pair these high dividend ETFs with broad market ETFs. By doing this, you're perfectly balancing out the defensive, steady cash flow of those dividends with the much higher long-term capital gains of the broader market. It's like building a fortress for your money. So as we wrap up today's explainer, I really want to leave you with this one provocative thought to chew on. Are you out there blindly chasing yields, or are you actually building true financial resilience? Take a hard, honest look at your investment strategy today. Ask yourself if you might have accidentally fallen into that dividend trap, or if you're actively, smartly balancing your approach. Thank you guys so much for diving into this analysis with me today. Keep learning, stay curious, and I'll see you in the next explainer.